Ladies and gentlemen, today we embark on a journey to explore the remarkable world of investing, guided by the principles of a true investment legend, Peter Lynch. Peter Lynch is a name synonymous with success in the world of finance. He's often hailed as one of the greatest investors in history, and his insights have helped countless individuals achieve their financial goals. Who is Peter Lynch, and why should you care about his investment philosophy? Peter Lynch is best known for his tenure as the manager of the Fidelity Magellan Fund, a position he held from 1977 to 1990. Under his leadership, this fund achieved extraordinary growth, turning $18 million in assets into a staggering $14 billion. What sets Lynch apart is not just his remarkable returns, but also his simple yet effective approach to investing. At its core, Lynch's philosophy can be summarized in a single phrase: invest in what you know. This mantra, while deceptively simple, encapsulates the essence of his investment strategy. He believed that everyday individuals had a distinct advantage in the stock market because they possessed first-hand knowledge about products and services they used in their daily lives. This knowledge, according to Lynch, could be leveraged to make informed investment decisions. What makes this principle so powerful is its universality. It doesn't matter whether you're a seasoned financial expert or a novice investor. The concept of investing in what you know is accessible to all. Lynch's approach essentially democratizes investing, allowing anyone with curiosity and diligence to participate. However, Lynch's philosophy isn't just about picking stocks based on personal preferences. It's about understanding the businesses behind those stocks thoroughly. This requires diligent research and a commitment to staying informed about industry trends and company financials. Lynch was known for his dedication to research, and he often said that the more homework you do, the more confident you become in your investments. Another fundamental aspect of Lynch's approach is a long-term perspective. He advocated for the power of patience in the world of investing. Instead of chasing short-term gains and trying to time the market's ups and downs, Lynch encouraged investors to adopt a long-term horizon. He often held onto stocks for several years, allowing the power of compounding to work its magic. Moreover, Lynch cautioned against trying to predict market movements or engage in market timing strategies. He believed that this was a futile endeavor and that it was nearly impossible to consistently predict short-term price fluctuations. Instead, he emphasized the importance of staying invested through market cycles and focusing on the long-term potential of your investments. In summary, Peter Lynch's investment philosophy is rooted in simplicity, accessibility, and a deep understanding of the businesses behind the stocks. It's about investing in what you know, conducting thorough research, adopting a long-term perspective, and resisting the urge to time the market. These principles, which we will delve into in more detail in the following chapters, form the foundation of Lynch's legendary success as an investor. As we progress through this guide, we'll explore how you can apply these principles in practical terms, identify investment opportunities, and avoid common pitfalls. Whether you're a novice investor or a seasoned pro, there are valuable lessons to be learned from the wisdom of Peter Lynch. Principle 1. Invest in what you know and understand. Peter Lynch's most famous and foundational principle is the idea that you should invest in what you know. This simple yet powerful concept centers around the notion that individuals have a distinct advantage when they invest in industries and businesses they understand intimately. Lynch believed that ordinary people, who were consumers and users of various products and services, had a unique ability to spot promising investment opportunities. The key to this principle is not just investing in familiar companies, but also thoroughly understanding the underlying businesses. It's about more than personal preferences. It's about in-depth knowledge. Lynch encouraged investors to become experts in the companies they considered for their portfolios, to understand their business models, competitive advantages, and growth prospects. Principle 2. Long-term perspective. Another cornerstone of Lynch's philosophy is the importance of a long-term perspective. He was a strong advocate for patience in investing. Instead of constantly buying and selling stocks based on short-term market fluctuations, Lynch recommended holding onto investments for the long haul. By adopting a long-term horizon, investors could benefit from the power of compounding, where their wealth would grow exponentially over time. Lynch himself often held onto stocks for several years or even decades, allowing their value to appreciate significantly. Principle 3. Avoid trying to time the market. Lynch cautioned against attempting to time the market. He believed that trying to predict short-term price movements was a futile endeavor. The stock market is influenced by countless variables, many of which are unpredictable, making it nearly impossible to consistently make accurate timing decisions. Instead of trying to time the market, Lynch encouraged investors to stay invested through market cycles. This approach not only reduces the stress and anxiety associated with constant trading, but also allows investors to capture the long-term growth potential of their investments. Principle 4. Diversify, but not too much. While diversification is a well-known risk management strategy, Lynch advocated for a balanced approach. He believed that investors should diversify their portfolios, but not to the point where they spread their investments too thin. Over-diversification, in his view, could lead to missed opportunities. Lynch recommended holding a mix of investments, including growth stocks, dividend-paying stocks, and potentially turnaround stories. This diversity allowed investors to benefit from various market conditions and economic cycles. Principle 5. Do your homework. Lastly, Lynch was known for his emphasis on thorough research and due diligence. He believed that investors should take the time to research companies, understand their financials, and stay up to date with industry trends. Doing your homework isn't just about reading financial reports. It's about actively seeking out information and insights that may not be readily available to the general public. This commitment to research and knowledge was a critical component of Lynch's investment success. The P/E ratio. One of Lynch's favorite starting points for evaluating stocks was the price-to-earnings (P/E) ratio. This ratio compares a company's stock price to its earnings per share. Lynch believed that a lower P/E ratio relative to a company's growth rate was an indicator of potential undervaluation. For instance, if a company had a P/E ratio significantly lower than its historical average or the industry average, it might be worth investigating further. However, Lynch was careful not to rely solely on the P/E ratio. It was just one piece of the puzzle, and he always emphasized the importance of understanding the business behind the stock. Earnings growth. Lynch favored companies with consistent and sustainable earnings growth. He believed that stocks of companies with a history of increasing earnings were attractive long-term investments. Lynch referred to these stocks as stalwarts and often held onto them as they continued to grow their earnings over time. When evaluating earnings growth, Lynch didn't just look at the past. He tried to anticipate future growth by analyzing industry trends and company strategies. He sought companies with a competitive edge that could maintain or accelerate their earnings growth in the future. Dividend yield. Dividend-paying stocks were another significant part of Lynch's portfolio. He liked companies that not only paid dividends, but also had a history of increasing them. A rising dividend was a sign of financial strength and management confidence in the company's future prospects. Lynch referred to dividend stocks as slow growers because they might not have the explosive growth of some other investments, but they provided a reliable income stream and could appreciate in value over time. For him, these stocks were a crucial part of a balanced portfolio. Strong balance sheets. A strong financial position was essential in Lynch's investment criteria. He avoided companies burdened with excessive debt and looked for those with healthy cash flows. A robust balance sheet provided a safety net during challenging economic times and allowed companies to invest in growth opportunities. Lynch was particularly interested in companies that could use their financial strength to repurchase shares, pay dividends, or reinvest in the business to drive growth. He believed that companies with these capabilities were more likely to reward shareholders over the long term. Cyclical versus non-cyclical stocks. Lynch understood that certain industries were cyclical, meaning they experienced periodic ups and downs. During economic downturns, he recommended investing in non-cyclical or defensive stocks. These were companies that provided essential goods and services that people continued to use regardless of economic conditions. Conversely, during economic upturns, Lynch favored cyclical stocks. These were companies whose fortunes were closely tied to economic growth and could experience substantial gains during economic expansions. The undervalued gem. The first stage of a stock's life cycle that Lynch often targeted was what he affectionately called the undervalued gem. These were stocks that he believed were trading below their intrinsic value, often overlooked by other investors.